Welcome to the tax talk, and we're going to discuss a lot of the major changes that were made. Primarily, we'll talk about individuals, but there'll be some business information as well that we're going to be talking about. And it's a little too late to plan for your 2018 return as far as making any changes for the year, but this will help you if you're as you prepare, get information ready for your 2018 return and going forward into 2019. I'm Bernie Dobrin. I've been doing accounting and taxes for over 35 years. But I did take the enrolled agent exam, so I am, as far as Internal Revenue is concerned, the equivalent of a CPA in representing clients before the Internal Revenue Service. Personally, I found the EA exam to be tougher than the CPA exam. But in any case, I do about 150 returns a year with my clients. With that, I'll let Ramon tell you who he is.
My name is Ramon Vasquez. I've been in this industry for about 15 years. I do multi-states. I do small businesses, large businesses, partnerships, trust estates, just about anything there is. You know, I'm pretty up for all of it. I do about 400 or plus so returns a year. Depends on, you know, what I have going on and what I'm able to get done. So, you know, taxes have been around for quite a while, coming up on just about a century now for our country. And within the last 2 years, we've had quite a large change to the tax system as we know it. So that brings us up to the tax reform. Everybody is going to be impacted by the tax reform. Personal returns, business returns. I haven't met anybody yet who hasn't either felt affected or been affected in some way, shape, or form. The effect, though, is going to be different. Effects for individuals are going to be different from effects for businesses and vice versa. Show of hands, how many feel that their personal situation is going to be impacted by how things have changed?
Negatively.
That was going to be my next question. How many feel that they're going to be impacted negatively? How about positively? Okay. And
we may wind up with a number of hands on the other side of the question by the time we're through.
So the tax reform impact affects you in several ways. First and foremost is going to be the filing statuses. While they did remain the same, the amounts for the standard deductions have changed. They've increased. And we'll get to the other side to that, but they have increased. The amounts have essentially doubled. Single went up to $12,000. Head of household has gone up to $18,000. Married filing joint is at $24,000.
You know, when we were preparing 2017 returns, we were able to do an analysis and comparison of what the previous tax law, the way the 2017 tax return was prepared, compared to the same numbers going into 2018. And just about everyone had a change. Some were better, some were worse. Normally, if you itemized your deductions, and you had more than $18,000, if you're married, filing a joint return, you had more than $18,000 worth of itemized deductions, you were going to come out behind. And we'll get into some of these things. Later on, we're going to talk about what hasn't changed, but what has changed are tax brackets, the percentages and the dollar amounts in those brackets are going to change. The personal independent exemptions, we'll get into that. Child tax credit, big changes there. If you have children or dependents, big changes there. The standard deduction, that's the one that everyone's been talking about all the time. Itemized deductions, there have been some significant changes there as well. So let's get into what we have. If you hear if we refer any time to the TCJA, it's the Tax Cut and Jobs Act of 2017. That's the one that we're dealing with right now. we may just call it the new tax law, or, the TCJA is a mouthful, and sometimes we'll just refer to other things as we go along. What hasn't changed? The earned income tax credit has not changed. The dependent care credit has not changed. Education credits in and of themselves have not changed, but education deductions. Some people were taking deductions for education expenses. Education deductions are no longer available. Only you have to qualify for the education credits to get any benefit from that. Social Security benefits, that's no change on that. The brackets and the dollar amounts and everything's remain the same. The IRA deductions haven't changed. Nothing as far as that's concerned. Self-employment above the line deductions, self-employed above the lines hasn't changed. So if you're self-employed, if you are self-employed, in order to get to the net income of the business, there's nothing that's changed there for you. Health savings account has stayed the same, and savers credit has stayed the same. So there's been a lot that didn't change, but the tax brackets have changed. This is where one of the most significant changes occurred. Now, the dollar amounts within those brackets, I think, remain the same, but it's just the percentages that are taxed. So you can see it went 10, 15, 25% for in the prior years. Now it's 10, 12, 22, and so on. And the top rate is 37% instead of the 39.6% from last year. And these are brackets that have been there for quite a while.
And so in theory, everyone should be saving a little bit of money this year and going forward until they're set to expire, which I believe is in 2025. The personal independent exemption, though. So the flip side to your increase in standard deductions is the elimination of a personal exemption. Before, you used to be able to claim a certain amount of money based on the number of people within the household, and that dollar amount was typically increased year over year to account for inflation and other items. However, because of the increase in the deductions, the standard deductions, they have countered that with the elimination of the personal exemptions. There are other things to help counter that as well. We'll get into those in a little bit, but as of right now, for what we're discussing, the concept of being able to claim someone and claim them in that regard no longer applies.
Just to give you an example of how that worked, in 2017, if you're a married couple filing jointly and you took the standard deduction and you weren't over 65, your standard deduction was $12,700. In addition to that, you got $4,050 per person as a personal exemption. So your total offset was just over $20,000. This year, that same married couple will have a $24,000 deduction for the standard deduction, but no personal exemption added to it. Everyone understand that one? Okay.
W-4 withholding. Out of curiosity, anybody in the room update their W-4? No? Anybody know they could update their W-4? Okay. So the W-4 form and how withholding is calculated has changed. Still relatively the same, but before, where you were able to account for your exemptions as allowances, the math is a little different. And that's going to impact how you have withholding for anticipation of filing for your federal taxes. Yes?
So where would one go to change their W-4, and what does it exactly entail overall? Like, do you go to your HR department, or is that a form that they need to produce to their...
You would typically go to HR. Some places have online systems where you can change it yourself. and you just submit it through them. And the worksheet itself is relatively easy to follow. However, you could always, ask for assistance for that if needed.
You can go online to IRS, has one of their links on the homepage, I believe, does have a link to a W-4 calculation.
And the W-4 is where employers hold back
That's
money to pay taxes.
right.
Correct.
And you fill in your estimated income, your married status, and your dependents. And it goes through a completely different series of calculations, which tie in more with the current tax law. Now that's changed twice, so what's going to happen at the end of this year may be completely different than what you may have expected. So just watch out for that, for surprises when you file your return.
You're still going to have what I used to call a marriage penalty, where one spouse makes more money, but when you add the other spouse's income, it puts you in a higher tax bracket, and then you got to compensate with your W-4.
Well, that's one of I haven't gone through the W-4 calculation myself. I've just left it. But the calculation does take into effect your total family income plus your dependents, which would generate the tax deduction, tax credit, or whatever. So there are a number of factors that get into it. The problem that you're going to have with 2018 is that because of the changes that they made in the withholding tables, the total being withheld for the year may not be what you expected, as opposed to what your tax is going to turn out to be.
Child tax credit. Prior to the tax law changes, there was a maximum of about $1,000, and the refundable portion was capped out at that $1,000. And the qualifying children had to be under the age of 17.
All right, let's back up slightly. Make sure you understand there's a difference in tax credits between refundable and non-refundable. At times when we talk about tax credits, it says you're going to get 1,000 or 2,000 or whatever earned income credits, and so on. Some of those are refundable, some of them are not refundable. If it's not refundable, all that does is bring your total tax bill down to zero.
Like
But you won't get money back.
You won't get money back. A refundable tax credit will give you money back. So when we talk here, you see the maximum tax credit goes up to $2,000. Refundable is $1,400. So what this means is that, say you've got a $2,000 tax bill at the end of the year, the whole tax bill will be offset by the $2,000. If you've got a $3,000 tax bill, $1,600 will be offset against that $3,000 tax bill. And I'm sorry, if you still have if you only have $1,000, sorry, you can only get $600 offset against your income, but $400 would be refunded to you.
And even with the age staying the same, the age requirement staying the same of being under the age of 17, they did lift the income limitations. And so those who in years past were unable to claim that credit due to income limitations no longer have that hindrance. And new this year with the new tax law is the non-refundable dependent care credit. Or sorry, not dependent care credit, dependent credit. It's for individuals who wouldn't otherwise qualify for child tax credit, but are qualifying dependents. You can claim a non-refundable credit for that.
Right. In the past, you got a $4,000 exemption for all your children over 17 or 17 and over, and any other family members that you were supporting. That $4,000 is gone. It's being replaced now by the $500 tax credit, non-refundable, which would be the same as a deduction. So whether that's your advantage or not depends on your total income and your tax bracket. If you make $50,000, and you're in a 10% tax bracket, that's $500 a two wash, basically, or $40,000. You'd have $400 savings under the old plan, and you get a $400 deduction here. So there is a wash between the two, depending, or it can be an advantage depending on how your dependents qualify.
Especially because they did lift, for this particular credit, they did lift the child requirement. As long as it is a qualifying dependent, you are eligible for that. In addition to it, they also lifted the Social Security number requirement. So individuals with a tax identification number can now qualify for this credit. Standard deductions. So here's what we started talking about earlier in the presentation about the increase in the standard deductions. As you can see, the amounts for the prior tax law are up there, as well as the amounts for the updated new tax law.
This for people under 65.
Correct. And so where this is going to impact a lot of people is the possible elimination of itemizing their deductions. Before, for married filing joint, when the highest deduction you had was $12,700, if you were to combine mortgage interest, medical expenses, taxes paid, things like that, charitable contributions, you could potentially itemize on your federal tax return. With the increase in the standard deduction, it may not be necessary for federal anymore. And so that could potentially impact a lot of people this year. Anything to add on that, Bertie?
Yeah, let's stay with, I mentioned this earlier, where I saw a lot of my clients that had itemized more than $18,000. When you take the $18,000 plus the $8,000 for the personal exemptions, they were at about $26,000 totals, which was higher than what the current new standard deduction is going to be. So they're going to kind of lose out because now they only have the $18,000 versus the $24,000, and their taxes are going to go up because they're not going to have a significant deduction.
And so the only exception to that would be for state and local filing, because certain states like Arizona do allow you to add back in certain items on your itemized deductions. Not only that, but Arizona in particular is not following suit with the increase in standard deductions like the federal government is. And so your standard deduction for Arizona is still significantly less than what it is for federal. And so even though you may not be able to itemize on your federal, you might almost certainly be able to itemize for your Arizona.
If you're going in to have somebody prepare your return for you, or if you're going to do it on your own, prepare or supply all the information for as if you were going to file a Schedule A, your itemized deductions. Because one, for Arizona, they don't have a threshold for health care. So if your health expenses are $10,000 and you're and you make $100,000, and we'll talk about this a little shortly, you have a threshold of 7.5% this year that you subtract from your total medical expenses that you're able to deduct. In 2019, that goes up to 10%. But in any case, so if you exceed the threshold or don't exceed the threshold, you won't get a medical expense deduction on your federal return. Arizona has no threshold. So 100% of your medical expenses would be added back to your itemized deductions.
It was estimated that about a third of taxpayers filed Schedule A's for itemized deductions. And so with the increase of the standard deduction this year, they're anticipating that amount to drop. And so it'll be interesting to see what those statistics look like this time next year. And speaking of those medical expenses, this is just a quick little screenshot here to show you how the influx of the percentages worked from 16, 17, 18, and then going on from 19. You can see how the percentages there dropped from 10 to 7.5% for, like Bernie said, last year, this year, and then going from next year, it'll be back up to that 10%. And that percentage is based on your adjusted gross income. So it's all cumulative income together that creates that that floor that you have to exceed in order for those items to be considered for your itemized deductions.
What's been eliminated within the Schedule A itemized deductions are all the deductions that were at the bottom of the form. If you're familiar with the form, the last category is other itemized deductions. That's the 2%. That includes the 2% threshold. It's basically, it follows the charitable contribution segment of the itemized deductions. But what this is that all your non-reimbursed employee business expenses are gone. Moving expenses, gone. Broker fees and such, gone. Not the trading fees, but the fee that the broker may charge you to maintain and cover and handle your account. That's no longer deductible. And I've had some fairly
Rough conversations?
No, some clients who have very large portfolios, and their deduction in prior years was $10,000 to $15,000. That's gone. Sorry to say, accountants' fees are going also. Well, we'll talk about a couple of others, casualty losses and so on. But I mentioned home office expense. If you have if your employer has you work at home and you or if you're, whatever you're doing, you're working at home, you don't have an office, and you deduct home office expense, that's no longer deductible.
As well as per diem for those truck drivers and people who are employed through companies that have to travel out of town for work.
Yeah. We'll talk a little bit about casualty losses and moving expenses, but so if your employer reimburses you, say, 30 cents a mile for driving to and from someplace, in the old days, you used to take the difference between 30 cents and the regular allowed fee of 55 cents that the Internal Revenue is allowing now as a non-reimbursed business expense. If you're a nurse and you have special shoes and uniforms, cleaning and all the rest of that stuff, or a carpenter, gone. Now, the only way to beat that, I don't want to say beat it because, but if you are self-employed and you have what's called Schedule C income, and you're not getting a W-2 for that, all those deductions are still deductible, as long as it's business related to your business, and you're showing income for that business. So, for example, if you're a nurse and you're a contract nurse as opposed to an employee nurse, all those expenses are still deductible. And you're getting what's called 1099 from the people that you are serving.
MISC.
Right, miscellaneous, to reflect that income. So you can still deduct all these expenses that we've been talking about that relate to that business. One of the big change that they've made in self-employment, non-W-2 income, is that if you're self-employed, there is a 20% of your qualified business income that you can deduct from your taxable income. Okay, so say you're a nurse and you work for 2 or 3 different patients, and each one of them gives you self-employment, a 1099 miscellaneous, and that totals $50,000 for the year on your tax return. That shows up on Schedule C as other business income. You get a deduction of 20%, or $10,000 from your adjusted gross income. Now, that qualified business income is applicable to a number of different sources of income. If you have publicly traded partnerships, if you are a member of a business partnership, If you have a subchapter S corporation or limited liability corporation, any income that would show up on your Schedule C or possibly Schedule E, which would include some of these other items, would possibly be qualified for your that 20% business income. So this is something that you should talk to an expert on, or go very thoroughly into your your income. But if you have any income non-W-2, some of it may be qualified for this 20%. There are limits based on the income. Certain professions, lawyers, doctors, athletes, if they make more than $150,000, some bracket above that, that income is not qualified.
And jumping back real quick to itemized deductions, some of the other items that were impacted were what we colloquially refer to as SALT, or your state and local income taxes. They've reduced that along with your real estate tax to a total of about $10,000.
Not about, exactly.
True.
Right.
And then that amount is cut in half if you're married filing separate. And so typically, you know, if you owned multiple properties and, you know, you had a brand new vehicle and, you know, a few other things, you know, you could claim all of this and you weren't limited to how much you could claim on your Schedule A for your itemized deductions. Now, with the new law, you're capped at that $10,000.
For that category.
Yes, for that category.
So on the
mortgage interest
on the
treated
tax
separately.
return, no, not mortgage interest, but real estate taxes, state income taxes. If you use the sales tax option in lieu of state income taxes, your car registration in Arizona. There's one or two others, if I remember correctly. Personal property tax, well, that would include the car registration. That's where that shows up. So that would be limited to $10,000. Arizona residents, for the most part, don't have, I haven't seen too many returns where they say, you've got to have a pretty expensive house here in order to get a $10,000 real estate tax bill plus your income. But if you're in a high income tax bracket, you know, your Arizona state income tax can get up to that area. So that's a limit. The interest, you got to be careful of. There's a couple of issues there. Mortgage interest is still deductible. However, the mortgage cannot, the interest on mortgages in excess of $750,000 is not deductible.
And that's your total debt.
That's your total debt. So if you have two properties of $500,000 each, or $500,000 mortgage on each, you only get a deduction for $750,000.
And some places that have high median home prices, such as San Francisco, where I believe the average price there is about $1.5 million, it's those areas that you're going to see a more significant impact by this.
Right.
By reducing the amount of mortgage debt that you're able to claim the interest for.
Right. So the other issue within the mortgage home mortgage interest is if you have a home equity loan. As of January 1st of last year, you will not be able to deduct interest on a home equity loan or a home equity, what do you call it, a credit line, unless the borrowing was used to substantially improve the house. I know people that they never took out a mortgage, they took out a home equity loan when they bought their house. And under the new tax law, that would not qualify except for the fact that it was used to purchase the house. Charitable contributions, that's been increased to 60% of income. In the past, you couldn't deduct more than 50% of your taxable income as a charitable contribution. So if you're very generous and so on, you know, you've got another 10% that you can play with.
Gambling losses.
The issue with, as far as gambling losses are concerned, they're still deductible as in the past to the extent that you have gambling winnings.
However, the definition of what is considered a gambling loss and wagering has changed. They've changed some of the language and the verbiage to include other items that weren't previously claimable in the prior tax law.
So in the past, basically what my clients would do, I tell them to run their player's card to see how much money went through, and hopefully that equaled out to what their winnings were. But in addition to what you can pull off of your player's card, or if you keep very extensive records, and how many of us do like that, cost of going to the gambling location, to the casino, can be deductible and added into your losses. So your transportation, your driving, your mileage to and from the casino, if you stay overnight, you can deduct that, add that to your gambling losses. Casualty and theft losses. We don't see that too often. Thankfully we're not in an area where we get hit by hurricanes and tornadoes and all the rest of that stuff. Maybe a little bit of flooding, but in the past there was a procedure where if somebody stole your car and you weren't reimbursed in full for it, what the car was worth, or if your house burned down and you didn't have a whole full reimbursement on that, you were able to deduct casualty losses or theft losses, with, as I said, with limitations. Now it's completely gone. Casualty losses and theft losses are no longer deductible unless you are living in an area that's been declared a federal disaster zone. So if you get hit by a hurricane and the president says that's a federal disaster zone, you are eligible to file a loss for that. Otherwise, no longer. Healthcare, the charge that for not having adequate health care is no longer in effect.
Effective January of this year.
Right. If you didn't have health care in 2018, you are still subject to the penalty. Moving expenses, no longer allowed for anyone except for military personnel moving under orders. So if you get a new job in New York City and the company doesn't pay all your expenses, you can't deduct anything. This is an area that alimony is an area that it's too late to plan for it anymore. Alimony in prior years was generally deductible as an expense by the spouse paying the alimony, and it was taxable income to the spouse receiving the alimony. And sometimes they use that as a income balancing, so that they reduce the tax bracket of the highly paid spouse. As of January 1st of this year, any divorce settlement or decree or court action or so on, any alimony that's determined to be payable is no longer deductible by the payor and no longer income to the payee. Now, the other thing is, if you are under a current settlement agreement with your ex-spouse, and for some reason you go in and modify that agreement, you lose your grandfather. Here's where one of the grandfather areas with alimony. Alimony settlements reached before January 1st of this year qualify under the old rules, regardless of anything else, unless you go in and make a change. If you make a change, then you are no longer grandfathered and you're subject to the new regulations.
K-12 expenses. So 529 plans, which before you had to use for post-secondary education institutions, now are eligible to be used for K-12 expenses. Your plans can distribute up to $10,000 each year for tuition and other applicable items for education per student, correct? With limit for elementary and secondary schools as it applies. Anyone here with children, grandchildren? Anyone where they've thought about setting up a 529? A few? Okay. Definitely would be worth looking into that, especially with your state credit savings. Anything out of that, Brittany?
No.
Alternative minimum tax.
A number of years ago, someone came up with the brilliant idea, well, we're going to tax the rich so that their deductions and exemptions and all the rest of the stuff that they're claiming brings them down to a zero or very little tax bracket. And they came up with the alternative minimum tax. And what happens under the alternative minimum tax is that there are certain adjustments made to your normal taxable income, and then they recalculate the tax based on that number, and then the tax that the taxpayer pays is the higher of the two numbers. Okay? Unfortunately, what was happening was that the rich were able to stay below the alternative minimum tax thing, if you wish, and a lot of middle-class people got nailed with alternative minimum taxes. So they've modified the alternative minimum tax, and a lot of it is going away because they've raised the limits and softened the adjustments before calculating the alternative minimum tax. It's kind of complicated. I'm not going to get into all the details, but if you've had alternative minimum tax issues in the past, you may get some relief under the new tax law. And that you'll have to take a look, talk to your tax advisor.
When to ask for help? I know that's a common question about people, especially if you're a DIYer. Personally, when it comes to just about anything, I prefer to try to use YouTube and Google to solve most issues myself. And so I certainly understand, those who try to take the self approach to doing things. There are just, a few questions you should really, start asking yourself as you're getting into it and, really trying to self-prepare and deciphering whether or not your situation has maybe become a little too complicated or beyond, a scope of where you feel comfortable being able to know that you're getting the right answer and or the best answer. Thank you, everyone, for coming. We appreciate it. Thank you so much.